Okay, welcome to Josh FX Room. All right, I'll be doing a series of Forex from basic, you get to advanced level. So this is going to be a series of Forex um, um, academy, like kind of like an academy process. So we're going to start from history of Forex to the advanced level of Forex. You get so yeah, let's dive in. So this is history of Forex. We're going to talk about how did Forex come about. So you've heard about exchanges, right? You've heard about how the exchange market came about. The what do you call it? Um, what the term exchange mean, because Forex simply means foreign exchange. So the term exchange means um, it means giving something and taking something in return. So it's kind of like it's kind of like a product, or rather a service changing hands. You're giving something to receive something in return. So that is what it means. So the history of money started with that form of exchange. You get. So we'll talk about those things now. Now, Forex Foundation. Now, money started as a pattern of battering system. There was a system called battering system, which means it was like a trade by barter. So I had to give you something to collect something. That's what they called it then. So it was a battering system or a form of exchange called battering system. It had to do with goods and services. So they had things that were traded, which was like livestock, sorry, skills and talents, people, and salt. You get. So, but there was an issue with the battering system, which the issue mostly was having something that no one else needed, limited shelf life, fair exchange wasn't mostly a fair exchange, and also transportation and storage was also a problem. And it was also hard to repay debt. So debts, amount of debts do accumulate, because then imagine I have something, I have let's say I sell, what do I call it? I sell books, and I have books and I need let's say, what is there? And I need phones from you, for example, right? You have phones, but you don't have books, and I have books. So what about if you have phones and book, and I only have books? I come to you and I say, please, I need some phones. Could we exchange? So it was a problem, because then what if you don't need what I have? You get. What if you don't need what I have? It means I may collect those things from you in promise to pay you back later on, or to bring back what you need, or what you would like me to get for you. You get. So there was a huge debt accumulation. It was a problem at that time. So because of these issues, they had to move to a different form of exchange, which they call the commodity system. You get. So commodity system here in Africa, we used to have what you call cowries. I know I'm used to cowries, but I'm not conversant. But I think it's almost the same thing, because in China and Africa, India, and some other part of it, they use cowries. I know about that one. And some people shells. I don't know about shells. I don't think I saw shells, but I know I saw cowries in the movies while I was growing up. You get. While growing up, I saw cowries in the movies. I saw this stuff. So in Japan, it was actually what was traded in Japan was the trade in Japan was based on the koku. So they had something which they call the koku, and it was at a unit of price. Then the shells was a specific weight of barley, you get, and they had yap stones. So yes, this was now a way. So it was like, let's bring out something of value that is going to be valuable for everybody as a whole. So if you have this, it would be like one of the things that's like a pattern of exchange between you and I. You get. So instead of you giving me phones and I give you book, if you have cowries, you can come pay me cowries and I'll give you books. And I can come pay you cowries, and you give me phones, then you can also take those calories to go and exchange somewhere else. So it was now like a way to solve that problem. But nevertheless, they had advantages and disadvantages. So the issue with that also, they had issue with the storage, and they had issue with the transportation as well. So it wasn't still enough. People didn't have, it was, these things were limited supply. You get, these things were limited supply. You get, so they couldn't have enough of it. So they came up with another idea. Now, this is the third phase of the exchange market, or how money came about, which is now coinage. I'm sure that most of you are conversant with the word coins. I think most countries, even till now, US use coins, they call it cents. And some countries, in my country, we use coin and we call it kobo. So it's called kobo in my country. So there were advantages and disadvantages. The advantages were people could actually trade what they wanted for what they needed. Coins were also easier to transport, and it was of a uniform coin. So everybody had the same coin. Everybody knew, okay, this is what we are using. So the disadvantage there was now coins' weight could change over time. You get, these things where they say the coins were made from electrum. So the weights could change over time. So coins could be counterfeited. People could remake these things. You get, people could make coins. Once they have the base and the things that they used to do, they could actually remake it. So coins were also very heavy to carry. So these were basically the disadvantages of that pattern. So we now move to paper money. So the Chinese invented paper money in the form of notes or IOUs. You get private institutions to store their gold and silver coins in exchange for paper notes or certificates. So I heard this story one place that Chinese came up with the idea. Then someone who's called Marco Polo, I can't remember his first name, but someone who's called Marco Polo was the one who went, who saw it in Chinese and brought this idea to America. And before you know it, people started embracing the idea of using paper money. You get, people started embracing that idea of using paper money. So now there was now a problem. There was now a problem. They went from paper money now to gold standard. This was what happened. So at the moment, there was an issue where there was this war, World War III. Was it World War II? I think it was World War II. So during the war, people used paper money. There was no need for it. So people used paper money to burn up and use to warm themselves because of the cold outside and all of that. So the exchange system, or the world exchange system, was not in a balance as at that time. So a lot of countries switched to using gold as their form of currency. You get, so it was all currency were to be backed by gold. Advantages to gold. You say most people were familiar with it. Naturally occurring material. It was a naturally occurring material. It kept inflation in check, and it had a fixed exchange rate. There was a fixed exchange rate. Now the disadvantage there now was that gold had to be free flowing. All country needed to maintain money supply to fixed quantity of gold. If there was a net transfer of currency from one country to another, gold would have to follow. You get, so they also had to carry gold. You get, and for people who know, gold can be very heavy as well. Large quantity of gold can be really, really very heavy as well. So this was when they now adopted the gold standard. This was when they adopted the gold standard. So after the war, they had it was so unstable. It was so unstable that what happened was, I'll give you some instance. So many countries abandoned the gold standard after the war. This was like in the 1930s. You get, many countries. There was this Great Depression. You get there was a Great Depression exposed problem. So many countries abandoned the gold standard. Currency fluctuated wildly. You get nations imposed tariffs and trade barriers. Global trade um, global trade actually collapsed. You get the economy problem helped create political instability worldwide. So they then had to come up with an issue. They then had to come up with a solution rather to solve that issue, right? So the solution was what they call the Bretton Woods system. You get so the Bretton Woods system was an internationally, or rather, was an international monetary arrangement where countries fix their currency to the US dollar. They get to the US dollar. So the US dollar was tied to gold at a fixed rate. As at that time, it was about $35 to 1 ounce. They say other countries agreed to maintain, and also other countries agreed to maintain a stable exchange rate with only small adjustments allowed, small adjustment allowed. So in practice, this made the US dollar the central global finance. You get, it made the US dollar the central global finance. Anywhere you go with dollar, you can exchange it. But as at 1944, was it 1944? They left um the Bretton Woods system was nullified. It was broken down. Let me see. I think I need to get the particular year. Yeah, I think I need to get the particular year. But yeah, so this was now introducing currency. Yeah. So from here you could read, also known as the adjustable peg system. You say International Monetary Fund. Yes, was created before the end of World War II, which was at July 1944. So the US dollar replaced gold standard, becoming the world reserved currency. So that was where this was the International Monetary Fund, kind of like what you now know as the World Bank. You get to incorporate all these currencies or all these countries and the economy in that same system. So the Nixon shock, say checks and balances. Say August 15, 1971, President Nixon closed gold window and announced that US would no longer back gold. So the this was the end of the Bretton Woods system. Yeah, this was the end of the Bretton Woods system. Yeah. So yeah, so that was what happened. So if you want to read more on this stuff, it is also good, but it's good for you to know the history of where you're coming from, of the trading. So this is about the history of Forex. I'll see you guys on the next video.